What are the tax consequences for Canadian snowbirds who visit the US? Canadian snowbirds who travel to the US, whether for a vacation or an extended stay, need to understand that they may face unwanted US tax consequences. Canadians often don't think about the US tax issues because they consider their main home to be Canada. However, the fact is, if you spend a considerable amount of time in the US, you could be considered a US tax resident. US tax residents are liable for US income taxes on their worldwide income. Even worse, US tax residents are required to file US foreign reporting forms with the IRS, or else face an ugly penalty of at least $10,000. So how much time is considered a lot for US tax residency purposes? Well, according to the substantial presence test, you will become a US tax resident if you spend more than 122 days, or approximately 4 months, in the year in the US. Assuming that you spend more than 122 days in the US in the year, how do you get out of being classified as a US tax resident? There are 2 ways. Number 1, claim the closer connections exception by filing Form 8840 with the IRS. If you can demonstrate that your personal, economic, and family ties are stronger to Canada than the US, then you will not be classified as a US tax resident. Number 2, file a US non-resident tax return and claim a treaty exemption from US income taxes. This exemption can be found on Form 8833. The Canada-US tax treaty basically says you are a resident of the country where your permanent home is situated and where your ties are closer to. So here's the tip. If you are a Canadian snowbird, hire an experienced cross-border tax accountant to help you out with the onerous US tax filing requirements. If you like this tip and want to know more, drop us a comment below or visit madanca.com. And as always, don't forget to like and subscribe so we can bring you great tax tips every week.